Hi, this is David from Real Wealth. This week I'm off heliboarding in Utah. I'm just about to board our helicopter in search of some fresh powder. So I'm going to cut over to James, our Senior Wealth Advisor, who will talk you through a new equal-weighted ETF by Market Vectors. Let's take a look. Hi and welcome to the video today about the equal-weighted ETF by Market Vectors. This equal-weight ETF is the first of its kind here in Australia. While it is quite normal place in places like the USA and the UK, Market Vectors was the first company to launch here in Australia about 12 months ago. So for today's video, I'll be using two reports by Market Vectors. Both of these reports can be downloaded from our website, www.realwealth.com.au, or from Market Vectors directly. The highlights for this ETF is that they have outperformed the ASX over the long run, has a better risk to reward trade-off, and has 3 times better diversification. So the fund differs from other ETFs or exchange-traded funds in that this fund invests equally across the different companies associated with the ASX Top 200, as opposed to a market capitalization exchange-traded fund or managed fund that invests based on the market capitalization of each company. What that means is the larger the company, the more of your money will be invested in that particular company. Whereas an equal weight ETF will invest equally across all of the funds. So looking at the Australian ASX Top 200, you can see our top 10 companies make up about 54% of the exposure to that ASX. So about 9.13% of your investment would be invested effectively with Commonwealth Bank, 8.9% with BHP, 7.3% with Westpac, etc. And if you look over these 10 companies, you'll notice how similar they are. Commonwealth Bank, Banking, Westpac Bank, ANZ Bank, National Australia Bank, etc. BHP, Wesfarmers, Woolworths, CSL, Rio Tinto. So effectively investing in a normal ASX type top 200 fund or ETF, you're effectively investing 54% of your money across 10 companies, which isn't a lot of diversification at all. Okay, and that is a high selling point or a high plus in my mind as to how much more diversification this market weight ETF gives us. Now, over the long term, both short term and long term, Market Vectors has outperformed the ASX and other ASX ETFs as well. If we look on this report here, from 2003 to the late 2014, early 2015, Market Vectors ETF outperformed by 38.82%. What that means for you as an investor, that over the last 10 years, you would be 38% better off than if you had invested directly in the ASX Top 200. So effectively, you make more money for taking on the same, if not lower risk. So personally, I've invested in this ETF along with Vanguard's ETF and iShares equivalent ETF, and I have personally seen on a number of occasions where the ASX has gone down, Vanguard's gone down, iShares has gone down, but this ETF has gone up. The reason for that is because the last couple of times has been because the banking sector has gone down. So ANZ gone down, National Bank, Commonwealth Bank have all gone down, dragging down the ASX and the top 200 as a whole. However, because the Market Vectors ETF is equal weighted across all of them, a lot of these other companies in the ASX Top 200 were going up, which meant that that ETF actually made money while a lot of other ETFs and the ASX actually went down. So in conclusion, I believe that MVW ETF from Market Vectors is very good. And if you're looking for exposure into the Australian market or the ASX Top 200, this would be a great place for you to start your research and your understanding on ETFs. So jump on our website, www.realwealth.com.au, or have a look at marketvectors.com.au for more information. Thank you.